All right. Good morning, everybody. This is the end of the month. There won't be another trading day in this month. So when you get a chance this weekend, look at your weekly and monthly candles, kind of get an idea of the way we're going to close on the week and the way we're going to close on the month. Maybe add to your bias or your perspective. This was the busiest earnings week in the quarter. And we managed so far to get through it without a major CFO or CEO putting a damp on their take within um, forward growth, the state of the economy, anything like that. So far, we did get some inflation data this week, which had the potential really to change the anticipated rate hike path. But I'm going through the numbers here and really not seeing much. A little unwind on the anticipation that we would still be raising rates by June. You can see the June 26 is getting a little unwind for that 25. But really, it seems to be the most on this curve at this point, just looking from one day to the next. Now, when we go out a little farther, rather than comparing one day and instead looking at the week, things change up a little bit more, but it still seems to be an unwind. If you start with May 3, the most immediate one, and how we're nearly guaranteed at this point to get a 25 basis point rate hike, which would take us from 475 to 5. So it'd have this big bar here. At this point, it's an 85% probability that we're going to get that rate hike. Then we get into June in the front end. And we're still looking at that same number. So this is where the pause is at right now, that it would still be 25 basis points, or it'd be a pause here, no increase, and we would still be sitting at 500. Then when we get into July 26, it's still showing the pause. What we want to watch for is if they start to unwind this and they start pricing in not a pause anymore, but an actual cut. And to do that, they're going to have to unwind this. So if these charts, if these graphs are a little intimidating for you or a little confusing, just focus on the really big bar and you want to see that number go down. Where it gets distributed, I mean, it should be to the bar on the left. You should see this 475 start to rise up. Very often they'll hit the easiest fruit first, right? The low hanging fruit. So seeing this bar on the far right decrease would make sense first. But either way, what this would be signaling is that it would signal that there's enough wreckage going on now that the Fed needs to be concerned that they've broken something and that they're now trying to cut in a chance of maybe avoiding a recession or an increased slowing. But at this point, with the inflation data that came out this week, we not only are looking at a solid chance to get 25 basis points in May, I think we're going to start to see June get bid up more. And then we start to see this rise for another 25 basis points in June. We're not seeing that yet. We're going to need more data. I really think that's what you want to watch for. That they kick the can down the road, shift the pause just a little further out. And that at this point, there's still nothing here that says that they're going to cut. Just pause. We're going to get more inflation data today, but the big one has already happened. It was Japan. And we do have a market maker move today already, which we'll see when we get over to Thinkorswim. So we can see Bank of Japan was putting out news last night. It wasn't too extreme yet, but we didn't really expect the guy to come out throwing Molotov cocktails or anything like that. Not yet. Give him a little time to settle into his shoes. So we can see here, markets are still on edge after data shows an uptick in US inflation, which boosts an expectation of an interest rate, not just next week, but potentially in June as well. All right, so here's your spot gamma levels. This is the SPX and the ES. And here is the NASDAQ. So you can capture those in a screenshot. If I went too fast, you can catch the recording. There is an indicator for Thinkorswim that draws these lines out. And I went through and I looked at the code. It really didn't seem like there was much there to calculate. I would have expected that it would look at the options data and the options chain, and I mean, no, it really wasn't that complex of an indicator. So how exactly they're deriving those levels and being able to put it into the Thinkorswim like that, I'm not entirely sure. But it does seem to line up with those. So if you were to just go to YouTube or not YouTube, but just go to Google and type in spot gamma Thinkorswim indicator, I believe you'll find it. It didn't have any other proprietary language that says this is ours, you can't share it. So it's probably going to end up in the Thinkorswim workbook. You'll be able to get it from there. On TradingView, you have to import the data every day. So it's a little bit of a pain. So we don't have any additional auctions today. there is a rig count at 1 o'clock, but I worked on those rigs for most of my life. And unless something drastic or extreme has happened, that rig count really isn't going to change all that much. You might lose a rig or gain a rig here and there. They might go down for maintenance or something, but otherwise, that number's really not anticipated to change. So while we don't want to just ignore it, there's very likely not going to be any impact from that data point. So by 10 a.m., you're going to get all the data that you're going to get, other than farm prices at 3 o'clock. But that gets us into power hour trading anyways, and it's not something that I would encourage or recommend. So by 10:15, 10:30 at the latest, for you 0-day traders, should be good to go. And on a end of week day like this, you got 0 days across the board and everything that's got weekly options. So plenty of choices. As I mentioned, we have a market maker move this morning. So we have a 21-day ADR of 1%, just a little over, really 107. With the market maker move and the data on deck, I would have anticipated a lower volume this morning, but I was a little surprised to see we're not looking at a lowered volume at all. We're right in the normal range, right around that 100 and a little above 100 at the benchmark at 7:30. So a little bit of a surprise that we had normal volume on a day like this. After we crashed upwards yesterday, had a really narrow range last night. The IB, initial balance, was very, very narrow. So in a generic way, when you see it this narrow, just think of unfinished business, right? The analogy that I use is, consider the idea that Sarah gets the phone call and her boss says, hey, grab, I don't know, 40,000 contracts of the ES today. So she's got that on her agenda. Obviously don't want to buy them all at once. She's got to feather that order through the market. With this showing literally no movement, she hasn't got her work done yet. If, on the other hand, we had seen wide, big, sweeping moves through the Globex already, then we could kind of infer from that she's at least started to get some of that work done and may already be finished. So in a tight range like this, the idea is the market has the potential to make really big moves because there's a lot of work still to be done, as opposed to a morning where we've already made really big moves. And the idea is that we're maybe less likely to make a big move at that point, since the work has already been done. Then we had a kill zone move between 2 and 4. Really nice algorithmic movement. I got that circled. The thing about an algorithmic movement like that, when it's very clean and very uniform and precise, is that by the time you realize that that's what it is, it's usually over with. So unless you're using something like Jigsaw or Bookmap that's reconstructing the trades for you and starts to point out really early that you have this uniform pressure coming in, you're very likely not going to notice something like this until it's already passed. If we do start to get a move today, I don't think we would just get to the market maker move. If we take 107 and add the 38 to it, that gets us at about 1.45. We're much more likely to go to 1.5 than we are to 1.45, right? It's just the way things work with the S&P. You're more likely to go to a percentage quarter than you are to land in the middle of that, right? So 1.5, 1 3/4, 1 1/4. Something else to consider is after that crash to the upside yesterday, it would be absolutely shocking to see yet another large, wide, sweeping move like we had yesterday. The only thing I can really say about yesterday is, at least at the very least, we weren't getting any signals that said short that sucker. Right? Like normally you get a decent run to the upside, it starts to feel like it's getting top heavy. You look for a little capitulation play and you flip it over and run it back the other way. And since there was no signal to short that, I just kept kind of putting the word out there that, there's no short here. So, don't try running the other direction. That does also fit for you swing traders. Kind of get into the habit that after a market has made a solid move in one direction, that you run it the other way. Sell into strength, buy into weakness. But there's times to flip that over, right? And buy into strength instead of sell into strength. Ten-day, 30-minute volume profile. We made it back to the point of control, moving swiftly through the shallow area here as we would anticipate. That's one of the benefits of using a volume profile, is to recognize if we are moving through a shallow area. $4,100 still has a lot of volume. So if we were to go back down there, we could anticipate a first touch, a little bit of support, but I wouldn't lean on it like a handrail. Don't trust that thing. Don't expect it to hold the market up. It'd be more of just first touch, a rebound area before continuing lower, if we were to come back down into that area. Right now, getting through the point of control is going to be the real issue, that 4150 area. And we don't yet have a classic B shape, just because the point of control is so big. But if we do come back down to that 4100, we're going to really focus on this lower volume area, this volume shelf, to see if it can hang out in this zone and begin to get more of that classic B shape. We still do have this shallow area here, so technically we have that air pocket of risk below us. If we break our own Globex low at this point, we very likely will move through that area relatively quick and get right back down to that 4100 area. The cog lines were really impressive yesterday, right up until the point where we exploded past them. There's a cog line at 4106, 4111, and then 4131. I really think that there's a new one. I haven't validated it yet, but I believe there's a new one around the 4150 area. And the cool thing about a cog line is once you have it, it's there. It doesn't go away. So at least all the work from validating it isn't like a one-day wonder. We have a VPOC at 4179. It's still a ways off. Depending on how you do your VPOC, you could consider that we're without one, that we wouldn't carry forward yesterday's point of control because we wicked through it right before that move through the kill zone. So since we didn't close on the other side of it, you could consider that it hasn't been hit yet. This is more about personal preference than anything else. I'm more inclined honestly, to market and run it across. But depending on how you do things, right, it's going to be something that you have to kind of decide for yourself. Whatever choice you make, you want to try to make it consistent. That way you don't you at least try to do the same thing the same way every time. Consistency in your analysis is a really big deal. So we'll carry that forward. 41.54 and a tick. While we're here on the 5-day, 5-minute, we can see that 41.27, 41.25 area. It's got a little bit of volume. So one of the concerns today is, and I'd already mentioned it, if we break our own Globex low, that we could fall through here really fast and get back to 4,100. But the thing is, every one of these is very likely going to be an area that we, like a tree branch, that we would hit if we were to fall out of the top of the tree. So consider what a really good double bottom would look like. If we came down and we came down again and we overshoot so that we can go lower than the previous low, trap all the bears, and then run back up again. Well, in that overshoot, how far would we expect it to go? I would say to that volume shelf. Then we bounce off of that and, we trap the traders, get our double bottom, squeeze them for a push, and we rally back up. If we broke through that level, then it would throw the whole idea of a double bottom off the table, and it would just be a continuation to the downside. Something to consider at least, right? Kind of a line in the sand. If you notice, it lines up with the 1, 2, 3, 6 fib level that I use. It's nice when everything has confluence. So what I just did there is measured this range up here. There is a wick that I'm attached to right there. You can measure big bars, narrow ranges. There's literally everything out there has some kind of system to it, some approach to how you can use it. If we were looking at that narrow IB last night and considering what a breakdown or a breakout would look like, because we knew price couldn't stay here forever, right? That's the only promise the market's going to give you. It has to leave that area at some point. You can measure that area and then try to determine what a downside breakout would look like or an upside breakout would look like, and measure and plot those levels. And you can see how price interacted with those levels. Something to consider. All right, I mentioned that it's the end of the month. And this is what we've got for the month. That doesn't look overly bullish or bearish. I mean, really, it looks like we haven't gone anywhere and we haven't done anything, which is exactly the point. We really got to get through this high up here. And so far, we haven't been able to do that since last May. Anytime we've gotten up there, they just sell into it and we come right back in again. So 41.38, maybe 41.40, right? I wouldn't get too hung up on exactly where that level is, but you can see how every time we got above that line, the market sold it back down again. No close on the monthly above that level. And here on the weekly, if you remember last year when the market got really bullish and we ran up into August, there was a 200 period moving average up here. And that's what we hit, and that's what we rejected from. Other than that crazy move up there into August of last year, we really haven't had much opportunity to get up above that level and keep it. This has been a pretty solid rollover at this point. But notice how these weeks all have this wick down here. Is when we sell off below this level, it gets bid up. So that's your 41.20-ish. Let's just put a level down there. 41.26. Now those are pretty narrow ranges in the grand scheme of things. And it's really kind of tightened everything up. That would be for you day traders. This would be more for the bigger picture. 38.75. We get below that level. Strong defense, a lot of liquidity. We're getting bid back up. So we got to get out of this box. That cyan line right there is the 10-day moving average. We're interacting with it. It's what we rested on yesterday for a little bit before we drove off of it. We've crossed back down through it this morning and then back up above it. Now we're just really holding it like a springboard. There's a reason that my indicator that I use out here focuses on that 10, the 10-day, the 10-week. So we're there. We're 1% above the 10-week right now, and we're still coming back down to it. Now, we don't always make it back down, right? More often than not, we do. We keep everything in a nice sine curve, sine wave, but not always, right? So this isn't guaranteed to make it back down to that 10-week. But we are at the 10-day right now. So we really need to resolve this level. Kind of like yesterday when we got there. And it finally did resolve it and then drive away from it. If we do break down through that 10-day today, and we start heading back to the south side of the chart, that 10-week is something you're going to really want to focus on. But at this point, that really seems like a solid bounce off of the 10-week and a really clean drive away from it. There's no moving averages over our head to deal with today. There's only moving averages underneath us, at least for the daily. So if we break the 10, then we've got the 20 down there as well to deal with. The 20 is at 41.26 and a half. All right, nat gas got whacked. Bitcoin down nearly 2%. Gold down 0.75%. Financials, energy. Oddly enough, semiconductors are still up this morning. Hong Kong had that inside day breakout and managed to rally back up inside the box, but just barely. Japan, really nice follow through, a really nice recovery. Remember, they have a new Bank of Japan leader and was, he was coming out, shaking things up a little bit. So seeing this close looks great. He didn't screw anything up. He didn't, manage to put his foot in his mouth, and the nation took what he had to say without throwing a temper tantrum. So I like this close, kind of see where it goes. For anybody who's in gold or silver or the miners right now, really consider what he talked about with that Bank of Japan 10-year and the yield control and how it's going to affect US dollar Japan, because that's the inverse product we use trading gold and silver and miners. So when we see this thing going up, we really got that anticipation or expectation of gold and silver and miners going down. So if you're long in those, this drive to the upside is probably going to be pretty punishing. And it's not likely to end anytime soon. right? I don't think it's done yet in any way. At the very least, you can anticipate from this rally-based drop area around 137.5 that we get back up in there and we take some resistance, at least stall and pause there, regroup, reconsider. So for gold, that would be where you'd expect support and maybe a bit of a rally. Gold, silver, precious metals, miners, whatever, right? Same thing. It's 1 o'clock in Europe. They're done with lunch. They should be back at work by now. Inside day breakout recovered back inside the previous day. We're now IX10. And I mean, I don't know, it's holding the line going into the close on the end of the week, at the end of the month, without crashing and burning. So, that's still one hell of a drive up. And now we're getting the rollover, and it's really more about, is this just a pullback? Or is this run done and we're going to come back and unwind it? TRB in the dollar, nice follow through. Keep in mind that a TRB follow through candle can be 3 times the size of this in an average, right? So if we were to add the high and the low of each of these and then divide it by however many days that is, that would be our average. Take that average times 3, and that's what you can get in a TRB candle. So the dollar could very easily get to 103 today. It's one of the reasons that I like that setup, because for a day trader, the setup is like a momentum magnification, where you get a day that looks like that with a TRB setup. Very often the target becomes the top of the last pivot. So just under that 103. If you want to trade the dollar, UUP is your vehicle. All right. I personally quit trading this thing. Every time I traded it with options, I got assigned. That got old fast. Tasty had a smalls exchange dollar, but once Tom sold Tasty, the smalls started getting unwound a little bit at a time. There's not very many of them left. This is one of those that isn't there anymore. So that sucks. You're back to using UUP, but it'd be nice to trade the dollar without trading this. I don't know what to tell you though. All right, 22% of the S&P is down 0.5% this morning or more. Scrolling through the list, we can see a few of the FANG names. Tesla, Google. Yesterday, my momentum scanners were picking up nearly all the FANGs, which is, I can't even remember the last time I seen something like that. Right, we got the positive momentum and the negative momentum names. Usually I gauge which one of these is, showing the most names, and I kind of use that for my starting point. Are we bullish? Are we bearish? So right now, the bullish momentum is obviously full of names, and the bearish one isn't. Yesterday, this thing was lit up with FANG names. Kind of explains why we crashed upwards. This morning, those semiconductors really stand out. And I'm still seeing Apple, Microsoft. So at this point, these names that are down 0.5%, it's really looking like it's just a pullback before a continuation to the upside. Kind of let that sink in a little bit. All right, and 21% of the NASDAQ is down 0.5% this morning or more. So the China ADRs, Bitcoin, gold, silver, the miners, energy, basically everything is down this morning except semiconductors. And bonds. But it looks like bonds are giving it back up. All right, well, the fade in the bonds is stronger than the rally we got in the S&P. It's certainly not the one causing the move. Maybe let's look at some swag levels. That's not my word. I'm gonna try to find a better word for that. But basically, when you think about the dollar and the VIX and SVXY, things like that, what is the corresponding level for something like the S&P? Kind of get a gauge for the day. So VIX above 20 would be, say, the ES below 40, 50. No, let's flip that around. Hold on. Yeah, I don't know. I like it. I like it. VIX below 16, we're going to expect to get above 4,200 in the ES. I think that's a reasonably clean assumption. The idea here is a year ago, we were seeing some really nice correlated market states, right? If the dollar went up, the S&P went down. If the dollar went down, the S&P went up. That was really, really clean, really easy signals. Now it's more of where the dollar is at. Hey, good morning. And not just the dollar, right? But we can do the dollar, the 10-year, like the TNX, TLT, VIX, and just kind of gauge these levels. So if you think about the VIX breaking 16 and the ES breaking 4,200, or the VIX breaking above 20 and the ES breaking down below 40.50. So with the VIX, when we come down into this low, into this structural support level, I want to be watching that to see if it's actually going to hold or not. And that a rejection there, a bounce and a rally in the VIX is very likely going to coincide with a rejection and resistance and a drop in the S&P. But that's just the VIX. So then you want to bring in something like the dollar. As the VIX is coming down into, say, that 16 level, where's the dollar? And is it going up into resistance as the VIX is going down, or is it going down as the VIX is going down? A lot of times the dollar and the VIX look exactly alike, but that's not a forever thing. It's not always that way. And then they're completely and totally opposite of each other. And just by the way, look at those daily candles. I am not looking at a bar chart, right? I'm looking at a candle chart, but those really look like bars. That's how much indecision we have here, and just how crazy things are right now. I mean, this is so odd. I can't even begin to express how weird this is, and I don't know where to find examples of it to study more up on it. When it comes to price action, I don't know what to do with that. If we ignore their shape and just focus on, you know, the TA, then we've got a very wide TRB setup. And at least on the weekly, we have a very clear chart. It's very clean. So we're really looking at the dollar below 101. That should be not necessarily a catalyst to drive the S&P, but think of it as a weight around the S&P. If the dollar begins to rally, it's going to put pressure on the S&P, downside pressure. So it's not going to make the S&P go down, but it'll certainly make it harder for the S&P to go up. The dollar breaking below, say, 101 and heading towards that 100, that's going to take pressure off and should make it easier for the S&P to continue that upside move, maybe even getting through resistance levels that it hasn't been able to get through. An old note that is still there, and it's still pretty solid. We're bullish above 4,100, we're bearish below 3,800, and anywhere in the middle of that, we're just chopping about like noise. But if you think about it, we're talking about the range literally that we have marked out here, 4,100 to 3,800. It was that. Now we've got above it, and we're up here in this noise. So maybe the note needs to be updated. 4050 to 4,200, just chopping about in that is noise. $33 is kind of the line in the sand here on the 10-year. As long as we're holding above that, things should stay normalized. I don't think we're going to see big expansion outside of the ranges that we've already got. All we did yesterday is expand to the top of the range, right? It's not like we had some big breakout. So as long as we're holding above 33, I don't think we're going to get above that 4,200. We drive below 33, and we get the VIX below 16, and we get the dollar below 101, you're looking at 4,200 plus, driving us into 4,300. Getting that rally back up here in the 10-year. I think 37 might be a little too far away. Really, I think we got to like bring that down a little bit. 36 or maybe 35.5. 35.5 might be a little tight. That really does kind of narrow us down into 36. So maybe approach it from that. Let's go 36.50. Yeah, I can make an argument for that. All right, so that's some pretty decent lines in the sand there. You know, we're on a weekly, so once we bring it over to the daily, it really kind of makes more sense. As long as the 10-year is maintaining inside of this range, the S&P is going to maintain inside of this range. And it'll be simple enough. And if we break out above here, we want to see the VIX also get above that $20. We want to see the dollar get above, say, 101. Now, excuse me, 103. Right? So kind of just putting the pieces together from different places. And really trying to determine here, what are we going to do with this? So this weakness today is not, it's not bearish. Just kind of keep that in mind, right? Come out to the daily chart. 50% is the line in the sand for the move that we just had yesterday, 41.23. As long as we're holding above 41.23, then that bullish impulse from yesterday has not turned bearish. Now, this is why waiting for confirmation isn't always the best way to go. You wouldn't want to wait until it got below that level just to take a day trade, right? I mean, for a swing trade or something, sure, maybe, but that would be the target if you don't want to wait for confirmation. It's just driving it down to that level. Still, as long as we're maintaining above it, then we're not bared up. As for, is that bullish drive from yesterday still intact? No. The trend is dead, and it's dead because we got below the 786. So if this was, you know, a regular trend, it shouldn't have pulled back more than 786, and then it should have continued. So the fact that it did pull back more than 786 says that that trend is dead. But a new trend can emerge, right? And that means that this doesn't have to turn bearish. And I just want to stress that note of caution because, well, semis aren't down. So here's SMH, AMD, NVIDIA. They're all either at the high, pressing the highs. MU. So if we got those, then we can start bringing in things like KWeb, JD, BABA, Baidu, PDD. And they're not down massively, right? They're just down a little bit. And if we get those and we start getting some of those Bitcoin names, those Bitcoin proxies, Riot, Mara, Coin, these also, they're not down massively. They're just down some. Now, when we started yesterday, I mentioned we had to get out of Wednesday's big box if we were really going to get anything. So here's the S&P. Here's Wednesday's big box, Tuesday's big box. When we started yesterday, I said we had to get past that, right? So then we rallied, we broke out of Wednesdays, and then we broke out of Thursdays. But there's Monday's close. So when we talk about getting outside of Tuesday's level, we didn't. That's where we took our rejection. So what we want to look for today is, one, to get back up to our own close of yesterday, close that gap first. Then we got to get through Monday's level, then set a new high on the week, HOW, high of week, set a new high of week, and then aim for that 4150 today. Pricing in a butterfly at 4150 for the end of the day today should be something really cheap. We're talking about 0-day option butterflies at 4150. The likelihood that we're going to get there is really low, which is why the butterfly should be really cheap, right? You can't build an SPX trade cheaper than 5 cents because, you know, it nickel size options, but you're talking about $5 max loss plus your commissions, you know, so, oh my gosh, 10 pennies, 10 cents, $10. Do I think we're going to actually get there? No, but that's the idea, right? Because we don't think it's going to get there, neither does anybody else. Pricing it will be a very cheap trade. And if you're wrong, you're going to lose 10 cents with commissions and everything. But if you're right, that thing could, you know, very well price in at $700 or $900 for risking $10. So it's something to consider. The market's not open, obviously. So pricing this right now is not going to reflect real price. Right now, it's showing 25 cents, but it's still reflecting that the SPX closed at 41.35 and that it's not going to open at 41.35, right? We're opening gapped down. We'll be farther away. So these options will be farther out of the money. It's something to consider. It's just so cheap. And it's one of those spot gamma levels and a tier 1 alpha level. And it kind of fits in with the idea that if we're going to do the opposite of what everybody thinks we're going to do, then, you know, going along with that butterfly makes perfect sense and it's really cheap. One of the reasons we kept going up yesterday is because everybody kept trying to short this yesterday, right? That we just kept squeezing shorts. It's one of the reasons for that drive. So something to consider, right? Everybody, be careful, be safe, have a good weekend. I'll see y'all next week.